For Britain's new Chancellor, his first budget couldn't have come at a more challenging time. The first 17 minutes of Rishi Sunak's address was devoted to combating the coronavirus.
We will get through this together. The British people may be worried, but they are not daunted.
There is a growing realization the economic impact of the outbreak could be severe.
This combination of people being unable to work and businesses being unable to access goods will mean that for a period, our productive capacity will shrink.
Sunak announced financial stimulus worth $40 billion to deal with the crisis. There will be extended sick pay for workers and support for small and medium-sized businesses struggling with cash flow.
Banks will offer loans of up to £1.2 million to support small and medium-sized businesses. The government will offer a generous guarantee on those loans, covering up to 80% of losses with no fees so that banks can lend with confidence.
There's also a commitment to support the country's already stretched health service.
Whether it's millions of pounds or billions of pounds, whatever it needs, whatever it costs, we stand behind our NHS.
As expected, on the back of the Conservative Party's commanding election win in December, this budget includes expanded public spending and an abrupt end to years of austerity. Roads, housing, education, science research, you name it, it gets new money. And no major tax hikes mean there'll be a lot more borrowing. Earlier, in what appeared to be a coordinated move, the Bank of England's Monetary Policy Committee surprised markets with an interest rate cut of 0.5%. This follows similar measures taken by the US Federal Reserve last week.
The reduction in bank rate will help to support confidence at a difficult time, to bolster the cash flows of businesses and households, and to reduce the cost and to improve the availability of finance.
The Governor has also promised high street banks 4 years of funding at the new rate of 0.25% to extend liquidity to struggling businesses. The announcements show just how seriously UK authorities are taking the coronavirus outbreak and its economic fallout. Simon McGregor-Wood, TRT World.
Let's get more on this now from Peter Dixon in London. He is the global financial economist at Commerzbank. Thanks for joining us on the program. As part of this budget, it includes a financial stimulus worth $40 billion to help the country get through the coronavirus crisis. How significant of a part of the budget is this, and what does it say about how seriously the UK is taking the coronavirus?
Yeah, I mean, there were two elements to the package, of course. One was the coronavirus effect, and one is the infrastructure project, which the government promised effectively in its election manifesto. But yes, the coronavirus part of the package, which is roughly half of the 40 billion that you talked about there, is significant. And it comes on the back of the Bank of England rate moves this morning, plus the package of measures designed to get credit flowing through the economy. So clearly the authorities in the UK are taking this very seriously, and I think they are ahead of the game, I think, in terms of the international response that we've seen from other European countries so far.
Mm-hmm. You mentioned the other part of the budget for infrastructure spending. Is the money being set aside for combating COVID-19 going to have any effect on that side of the budget? What's been set aside for that?
No, I mean, I think the two are separate, if you like. I mean, the COVID-19 part of the budget really only affects the fiscal year 2021. And it could be quite significant. I mean, I think the UK could run a much bigger deficit than the current government figures are suggesting. Thereafter, of course, it's a question of whether the markets are going to be sufficiently willing to continue to fund the UK if the budget deficit in the upcoming fiscal year is bigger than anticipated, because, of course, the infrastructure plans very much rely on continued market access. So, in a sense, they are linked, but financially, of course, they are separate.
Right, and no major tax hikes. Where is all this money going to come from?
Well, I mean, I think that's a very good point. Basically, what the government has done, it said we're going to borrow huge amounts of money at the current very low interest rates for the next 5 years. Hopefully, that will work out, but it is a risky strategy. If at some point interest rates start to rise, or if the markets suddenly decide they don't like the UK in the post-Brexit environment and demand a risk premium on government bonds. So, there are some fiscal risks, I think, built into these numbers.
Let's talk about that interest rate cut by the Bank of England, which came a few hours before the release of the budget of 0.5%. Do you think that this is just the first step in the stimulus measures being put out there to combat the virus? Because we're still learning the global impact of this virus. Do you expect to see more down the road?
Well, I think you'll see more from other central banks. I mean, I think the Bank of England is almost out of ammunition. I mean, they maybe have another 15 basis points to go on the interest rate. But the important part of the package was not the rate cut itself. It was the measures designed to ensure that credit continues to flow to small and medium-sized enterprises. And I think you can expect to see a similar response tomorrow from the ECB, a modest interest rate cut, but certainly measures put in place to ensure that funds can be channeled to those parts of the economy that need it in order to tide it over in case things get really rough.
And one more question about the budget. What lasting cost of Brexit are we seeing in there?
Well, funnily enough, not much. It was pretty much swept under the carpet. But I think there are two things which you have to really factor in. One is that obviously the UK is going to grow more slowly over the next 5 years than it would have been had it been part of the EU. And as a consequence, revenue growth will be slower than, I think, than the government currently anticipates. And the second one, of course, is that migration will likely be rather lower over the forecast period as well. And as a consequence, that will limit the labour contribution to growth. It will certainly cause bottlenecks in certain parts of the UK labour market. And as a consequence, again, I mean, I think the flip side of that might be that you start to see localised wage inflation building up in the forecast. So, I think there are certainly Brexit risks which were not addressed today.
All right, we'll leave it there. Peter Dixon joining us from London. Thank you.